Imagine waking up on a Tuesday morning in Adelaide. You stumble into the kitchen, still half asleep, switch on the kettle and start making your coffee. While you're waiting for it to brew, your phone buzzes. You check your account and discover that while you were sleeping, your money quietly clocked in for another shift and sent you a paycheck. No boss, no alarm clock, no meetings that could have been emails, just money showing up because you own assets. That, my friends, is the dream a lot of Australians are chasing right now. And today, I'm going to show you exactly how much money you need invested to live off dividends forever in Australia. Let's get into it. Living off dividends in Australia is actually one of the most achievable forms of financial freedom anywhere in the world. And the reason is something that's almost unique to us. It's called franking credits. Now, I know that sounds about as exciting as reading the terms and conditions on your internet bill, but stay with me because this matters. When an Australian company pays you a dividend, it has usually already paid 30% company tax on those profits. Instead of taxing that same money again, the government gives shareholders a credit for the tax already paid. In simple terms, you get a tax advantage that investors in many other countries would absolutely love to have. So when you see a dividend yield of 4% on the ASX 200, the real grossed up yield can be closer to 5.5% or even 6%. That's a pretty serious boost. This system was introduced back in 1987 under the Hawke government to stop company profits from being taxed twice. Australia and New Zealand are among the very few countries that still run a full dividend imputation system. Meanwhile, investors in the United States, the United Kingdom, and much of Europe often get hit with double taxation. That's why an Australian portfolio yielding 4% can outperform an overseas portfolio paying exactly the same headline yield. Not bad for a country famous for kangaroos, meat pies, and arguing about property prices. Now let's get to the question everyone wants answered. How much money do you actually need? According to the Association of Superannuation Funds of Australia, a comfortable retirement for a single person costs around $54,000 per year. For a couple, it's roughly $77,000. That includes things like private health insurance, running a car, going out for dinner occasionally, taking a domestic holiday without checking your bank balance every 5 minutes. It's comfortable, not billionaire comfortable, but definitely not instant noodles and regret comfortable either. If you want a more modest lifestyle, you're looking at roughly $35,000 per year for a single person, $51,000 per year for a couple. And if you're aiming for the full fat premium lifestyle, international holidays, nice restaurants, upgrading the car every few years, maybe finally buying the coffee machine that costs more than your first car, then you're probably looking at $100,000 or more annually. So how much capital do you need invested? The average dividend yield across the ASX 200 currently sits around 4%. Once franking credits are included, that can rise to roughly 5.5%. Investors who tilt toward higher yield shares might achieve between 6% and 7% grossed up. For today's calculations, let's use a realistic middle ground figure of 5.5%. Here's what the math looks like. If you want $50,000 per year, you need approximately $910,000 invested. If you want $75,000 per year, you'll need about $1,336,000 invested. Want $100,000 per year? That's around $1,820,000. And if you're dreaming of a lifestyle costing $150,000 per year, you'll need approximately $2,700,000 invested. Now, before you click away thinking, well, that's impossible, hear me out. These numbers are not reserved for surgeons, CEOs, lottery winners, or that one friend who somehow made millions buying Bitcoin in 2012. Ordinary Australians can absolutely reach these numbers through consistency and time. But there's a catch, and it's called tax. I know, everyone's favorite topic. Even with franking credits, dividend income is still assessed under your marginal tax rate once you exceed certain thresholds. The good news, Australia's tax-free threshold is currently $18,200, and franking credits can dramatically reduce the amount of additional tax you pay. In fact, if dividends are your only source of income, you can earn around $30,000 in fully franked dividends and potentially pay very little or even zero net tax. That's one of the biggest hidden advantages of dividend investing in Australia. Now here's the part most people completely underestimate. You do not need to save $900,000 from your salary. You need to invest consistently and allow compounding to do most of the heavy lifting. Let's say you invest $1,500 every month into a diversified Australian share portfolio, earning an average total return of 8% per year. That's actually below the long-term historical return of the Australian market. At that rate, you'll reach approximately $900,000 in about 19 years. Increase that contribution to $2,000 per month and you'll get there in around 17 years. Start in your late 20s 20s, and you could be financially free before you turn 50. That's not fantasy, that's mathematics. And unlike your New Year's fitness goals, mathematics doesn't care about motivation. There's another tool that many Australians overlook: superannuation. Holding dividend-paying investments inside super can be incredibly tax efficient. During accumulation phase, earnings are generally taxed at 15%, and once you enter pension phase, investment income can become tax-free. That's why many financially savvy Australians use a two-portfolio strategy. One portfolio inside super for long-term tax efficiency, another portfolio outside super for income that can be accessed before preservation age. It's a powerful combination. Now let's talk about a mistake that wipes out a lot of beginner investors: chasing yield. If you see a stock paying a 12% dividend yield, your first thought should not be, "Wow, what a bargain." Your first thought should be, "What exploded?" Because extremely high yields are often warning signs. Usually either the company's share price has collapsed, the business is struggling, the dividend is about to be cut, or all three. The companies that build wealth over decades are usually the boring ones. The big banks, BHP, Wesfarmers, Telstra, Woolworths, major insurers. They aren't exciting. Nobody is bragging at a barbecue about their thrilling Woolworths dividend. But boring companies have a habit of quietly making people rich. And remember, the goal isn't excitement, the goal is freedom. For many investors, there's an even easier option: dividend ETFs. These funds do all the heavy lifting for you. Popular examples include VAS, VHY, IOZ, INCM. Instead of researching dozens of individual companies, one ETF purchase can instantly give you exposure to anywhere from 50 to 300 dividend-paying businesses. For most Australians, a simple 2 ETF portfolio will outperform the majority of stock pickers over a 20-year period. And you'll probably sleep better too, which is important, because checking your portfolio every 15 minutes isn't technically an investment strategy. It's also worth understanding how the money actually arrives. Most Australian ETFs pay distributions quarterly, typically around January, April, July, October. Many individual ASX shares pay twice per year, usually an interim dividend and a final dividend. That's why some investors deliberately build what's known as a dividend calendar. By mixing ETFs and individual shares, they create a stream of payments that arrive throughout the year. Instead of waiting 6 months between payments, cash lands in the account far more regularly. And when you eventually transition from a salary to investment income, that consistency can feel much more comfortable. Now let's talk about the villain in every financial plan: inflation, the silent wallet thief. If you need $50,000 per year today, you'll need roughly $67,000 in 10 years, $90,000 in 20 years, assuming inflation averages around 3%. Thankfully, quality Australian companies tend to grow their dividends over time. Many large companies have increased dividend payments by roughly 4% to 5% annually over long periods. That's one reason dividend investing remains effective for long-term financial freedom. Your income can grow alongside your expenses. Finally, let's talk about the secret weapon that turns a snowball into an avalanche: the dividend reinvestment plan, or DRP. While you're building your portfolio, instead of taking the cash, you automatically reinvest dividends into more shares. Those new shares generate more dividends. Those dividends buy more shares. Those shares generate even more dividends. And the cycle continues. It's basically the financial equivalent of planting a tree that keeps planting more trees. By the time you're ready to live off the income, your portfolio could be producing dramatically more cash flow than if you'd spent those dividends along the way. So let's bring it all together. To live off dividends forever in Australia, you're realistically looking at somewhere between $900,000 and $1.8 million invested, depending on your lifestyle goals. You get there by investing consistently, using quality dividend stocks or ETFs, taking advantage of franking credits, avoiding dangerous high-yield traps, reinvesting dividends while you're building wealth, giving compounding enough time to work its magic. The best part? You don't need to be rich to start, you just need to start. Because every dividend investor you've ever admired began with their first share, their first ETF, and their first dollar invested. And one day, if you stick with it, you'll wake up, make your morning coffee, hear that notification on your phone, and realize your money has been working while you were sleeping. That's when the game changes. If you found value in this video, hit the like button so more Aussies can discover it. Subscribe if you haven't already, and turn on notifications so you don't miss future videos. Thanks for watching, and I'll see you in the next one.